The physical blockade of the Strait of Hormuz has severed one of the world's most critical energy arteries. Right now, millions of barrels of crude are trapped in transit, structurally capping global supply. Yet, looking strictly at top-line U.S. indices, you might think the crisis was over. The S&P 500 and the Nasdaq 100 have both posted gains of over 1%. Traders are characterizing this as a cautious rebound, a pivot from panic hedging to aggressive bargain hunting. This split-axis chart illustrates the exact contradiction. On the left, the green line shows the S&P 500's relief rally, but on the right, the structural war premium remains entirely intact. Brent Crude is pinned near $102.87 a barrel, and the India VIX remains elevated at 23.51. This creates a volatility paradox. The daily equity gains are mathematically hollow. The underlying pressure from high energy costs and deep institutional fear is actively throbbing beneath the surface of the index. Because of this paradox, broad market correlations are no longer reliable. Beta is a measure of an asset's volatility in relation to the overall market. Normally, a rising S&P 500 lifts global equities in tandem. Right now, those correlations are failing. The energy shockwave has forced a violent decoupling of regional markets. Locating institutional alpha requires us to abandon broad assumptions and map how specific regions are absorbing this exact shock. On this wireframe map, we track a geographic methodology that isolates 4 distinct monetary regimes: North America, Europe, the Middle East, and India. A single exogenous variable, the Gulf energy blockade, is striking all 4 regions simultaneously. But because of their distinct local economics, the exact same shock produces entirely disparate asset pricing models. We have entered an environment of absolute macro decoupling. A single strategy will no longer work across borders. Surviving this environment depends on tracking exactly how local central banks formulate policy, and whether domestic liquidity can act as a firewall against a global energy crisis. This candlestick chart tracks the S&P 500 attempting a technical relief rally from the 6,699 floor, trying to fill the gap near 6,750. The fundamental catalyst is the Federal Reserve, with a 98% probability priced in that the Fed holds rates this week. Technical internals are flashing severe warnings. The hourly chart reveals a death cross, indicating heavy downward momentum. If the Fed signals only one 2026 rate cut, this weakness drops the floor directly to major support at 6,550. U.S. equity stability is an illusion. The entire relief rally is at the mercy of avoiding a hawkish surprise from the Federal Reserve. In Europe, the situation is far worse. Germany's DAX index remains the absolute epicenter of the global industrial crisis. This DAX candlestick chart clearly shows underperformance. It is tracing a bearish flag, a brief upward trend followed by a sharp drop, signaling that downward momentum will continue. The core headwind is stagflationary decay, bleeding corporate margins dry. ECB President Lagarde warns the oil war premium may force a July rate hike. As Brent Crude climbs, manufacturing costs spike, crushing European valuations. This forces a harsh sectoral rotation. High-beta industrials are being actively dumped. Capital is retreating into slow-moving, defensive utilities instead. Without a full diplomatic resolution to the Gulf blockade, overhead resistance on the DAX at 24,100 is structurally impenetrable. Conversely, the Saudi TASI index is exhibiting absolute relative strength, completely ignoring the decay impacting the Western Hemisphere. This TASI chart shows a textbook uptrend. Driven by an oil supercycle, massive fiscal windfalls and Saudi Aramco dividend yields are decoupling the Middle East from European stagflation, allowing institutions to confidently buy every dip. In Asia, Japan's Nikkei 225 also appears to be decoupling, snapping its losing streak with a sudden 1% tech-led surge. Japan has generated rare internal growth catalysts. A 1.3% GDP revision, combined with the first real wage increase in 13 months, provides a domestic floor against external shocks. But this split view highlights a fatal structural flaw. On the left, the Nikkei forms a bullish piercing candle, suggesting an upward reversal. On the right, the US dollar to yen exchange rate sits at a punishing 157.97. This severe yen weakness violently inflates the cost of Japan's oil imports. The resulting national energy bill will cap any sustained equity recovery at the 54,500 gap. Corporate earnings are secondary right now. Geography and energy independence dictate equity survival. This brings us to India, which currently serves as a global case study for domestic liquidity resilience under extreme pressure. This hydraulic system illustrates a massive institutional tug-of-war. The red column shows foreign capital flight of 9,365 crore rupees pushing down. Meeting that pressure is an unprecedented domestic liquidity cushion of 12,593 crores rushing in, resulting in a stabilizing positive delta of 2,668 crores. This internal liquidity pool is holding the line despite severe external pressures, fighting off both $103 Brent Crude and the rupee hitting a record low of 92.42 against the dollar. The Indian market is effectively decoupling its stability from global panic, relying almost entirely on internal retail and institutional absorption. The sheer force of this institutional collision is causing violent sectoral rotation beneath the index surface. The headline Nifty numbers hide aggressive portfolio restructuring. This segmented heat map reveals capital flight. Auto cyclicals are bleeding, dropping Mahindra & Mahindra and Tata Motors 4%. But that capital seeks refuge, flowing into defensive PSU energy and pharma. Coal India surges 6%. Reliance Power jumps 3.8%. The logic is entirely defensive. These specific sectors act as a direct operational hedge against the combined oil and inflation pincer squeezing the broader economy. Portfolio managers must adopt a strategy of selective bullishness. You can find tactical windows for gains, but they must be executed strictly within a broader, deeply cautious macroeconomic framework. Broad index funds will suffer in a structurally broken market. Generating returns requires precise, tactical allocation. This chart establishes hard technical boundaries for the Nifty index. The critical support floor sits between 22,923 and 23,207. A tactical pullback rally from this band targets a 23,700 exit, but any decisive break below 22,900 invalidates the thesis, resuming the market crash. With the Strait of Hormuz blocked, the war premium in Brent Crude is a permanent fixture. Holding unhedged long-term equity exposure in this environment is a mathematical error. High global correlation has fractured. The network has restructured into isolated clusters, where regional energy security and local liquidity dictate the next move.